Welcome, everyone. Kevin and I are back, another Financial 15. We're going back to tax savings, ways you can save tax. You can use this in retirement. You can even use it prior to retirement. It's using a prescribed rate loan to cut down that tax bill. You want to stick around.
Yeah, we are always asked questions on how we can save taxes, and that's one of the big things that we always want to deal with. So one of these things to look forward to, we are going to deal with prescribed rate loans. You're going to describe it. We're going to let you know how it works and everything else along those lines. If you want to see this video or more, please subscribe to our YouTube channel. You can get all the information that we have, lots of content there, always interesting things to find out. If not, please like us on Facebook, or more importantly, go to our website at beckerorr.com. We've got this, we've got our back and forth, we've got everything else there, including the webinars that we've done beforehand. So today we want to talk about, though, the tax saving possibilities with a prescribed rate loan. Clint, I think for most people, what you have to describe is, what is a prescribed rate loan and how is it applicable to everybody else out there?
Absolutely. It's not terminology here all the time. So quick definition there. In a nutshell, it's a tax strategy. It's a way to split income. That's the idea. And there's lots of ways you can do it. We're going to show you an example where a higher income individual, higher income spouse lends money to the lower income individual, and that's where the tax savings occurs. It can be done through legal entities. So you can have a trust, you can have a corporation, a holdco, lots of ways you can structure this. But the general idea, often it's called a spousal loan because they do it between spouses. And that's the example we're going to go through. But before we even get to that, we got to start off with a quick tip on a prescribed rate loan. Important, both lender and borrower must be Canadian residents. So if you're in the US or if your spouse is from another country, not for you. Don't do this one. You both have to be Canadian residents. Otherwise, it's not going to save you any tax. So that qualifier out of the way, let's start to dig into some of this here, Kevin. We'll start with a little basics on the investment accounts, because that's going to be important to understanding how this can actually save you tax. What are we looking at here?
Yeah, basically, if it's going to be dealt with, it has to be dealt with more on a non-registered side. As we can see, RSPs, RIFs, LIFs, TFSAs, all of those have tax sheltering right now. And when the income comes, or when they're withdrawn out of there, it's all taxable as income. So doing something along those lines doesn't really help you at all. It has to be what's substantial in size for a loan, and it has to be done in a non-registered account. This way, you can write off aspects of what you're dealing with on the loan and the interest for it. So that's why it's got to be a non-registered scenario. Joint account, cash account, corporate account, trust accounts, a variety of different things. But as we mentioned, we're going to be basically dealing with the spousal side of things and how the claims must work each year. Because as we say, every year on a taxable account, you have to pay taxes on what's there. So this is where the strategy comes into a whole bunch for you.
Absolutely. So we're looking at those non-registered assets. Let's set up the example here, and then we'll provide a couple of tips as we go. First example of Jerry and Ted. They've got non-registered investments like we just talked about. There's $1 million there. So very nice non-registered account. They live in Manitoba. Really, they can live anywhere in Canada. We just picked Manitoba because that's where we live. Key here, Jerry is in the highest tax bracket. Her income over $250,000. Ted, a lower income, $35,000. That difference in income is key to this strategy. And then part of the example, we're going to say Jerry is going to loan Ted money. Loan Ted $1 million. That gets invested in the non-registered account. So you have $1 million portfolio in Ted's name. And we're going to say it generates 5% per year. The higher the growth rate, the actual more tax savings there'll be. But we're going to keep it simple. Say it's 5%. And we're going to say it's income. You can get capital gains, dividends, which would likely be the case. But again, simplicity of the example, we're saying 5% of interest income per year on that $1 million portfolio. Before we show you the tax savings, a few key items for this prescribed rate loan. The first one here, Kevin, it can't be a handshake deal. You have to have something written down.
Yeah, we have to have it as a written agreement. I mean, I'd love to be able to say, hey, I'm going to give my wife this much money, and just because I said it, the government has to accept it. Of course, we know that never happens that way. You have to have some sort of backing to be able to do this. So you have to set this up as a written agreement. That has to be dealt with first, and you have to sign a whole bunch of things to say, this is the amount I'm lending, this is the rate I'm lending it at, and these have to be documented so that everybody knows what's going on.
Yeah, and part of it is the loan, it has to be an actual loan. You have to charge interest. So if Jerry lends Ted money, Jerry has to charge Ted an interest rate. And CRA, the government of Canada, sets out a minimum, what they call a prescribed rate of interest, hence the title prescribed rate loan, because you're charging that prescribed rate of interest. They update it quarterly. Currently, it's 1%. I imagine it'll be 1% for a while, but eventually that rate might start to rise. So at a minimum, that loan has to charge the prescribed rate of interest, which is currently 1%. So Jerry's got to lend Ted the money, and then Ted has to pay that 1% of interest. And they actually have to pay the money, don't they, Kevin? They can't just
yes, they do.
They can't just put it on the taxes. Cash actually has to change hands here.
Yeah, because if not, I mean, that's the biggest factor for a loan in going forward. You have to be able to make payments on it. Now, as we say, the loan can be interest only. This isn't like something where, you've got 84 months to pay off your car loan. You can keep that $1 million for a long period of time and only pay the interest. So based on our example, I mean, there would be $10,000 every year that Ted has to pay Jerry for that loan based on the 1% on $1 million. So it does have to be paid, and it does have to be paid by that time frame. Otherwise, there could be complications when you're dealing with taxes, write-offs, and everything along those lines. So it must be paid. That's a definite going forward.
Yeah, and January 30th is key there. If they don't have the payment prior to January 30th, let's say they miss one, even if it's just one, the attribution rules can kick in, and then your tax strategy kind of goes out the window. Essentially, the idea here is Jerry's going to lend Ted money. Ted's going to invest the money under his name, and he'll deal with the taxes of those investments. But if they don't deal with the loan correctly, let's say they miss one of the payments before January 30th, all that income can be plopped back onto Jerry's tax return, and that just messes up the whole strategy.
Yeah.
So to avoid the attribution rules, you have to make sure you get these details right. You make that interest payment. A key item here, the lender has to claim it as income. So in this case, Ted's going to have to pay that 1%, that 10 grand, like Kevin just mentioned. Jerry's going to have to claim it on her tax return as income. And then Ted, the borrower in this example, he can write it off. He said, you know what? I'm using this loan for investment purposes. I can deduct it. I can write it off on my tax return. So that's permitted. He pays the $10,000, gets the deduction. Jerry has to receive the $10,000 and claim it on her tax return. Are there any limits here, though, Kevin? What kind of number can they do for the loan, and what kind of time frame can they use?
Yeah, those are key points that you just mentioned in regard to what has to be happening in going forward. But yeah, in regard to limit, there is no amount that you have to worry about in what it is. It can either be 10 grand, it can be $1 million, it can be 3 million, it can be anywhere in these bounds. There's no limit amount that you can borrow. So the more you borrow, actually, the more you can probably save in taxes down the road, which is odds and ends of what goes on from here. But yeah, there's no limit, and there's no time frame on the loan. So it's not like I have to make the loan today. It's a 5-year loan. It's got to be paid off, a mortgage, things along those lines. It can last 10, 15, 20 years if you want it to without any problem. And it can be an interest-only payment at that time. So no limit, no time frame that we have to worry about on the loans.
There we go. So we know some of the details. Let's fast forward with the example here, move on to the next step. So we have the Jerry, we have Ted, Jerry in the higher tax bracket, Ted in the lower tax bracket. Jerry lends Ted the money, the $1 million at the 1%. Scenario number one. So just to understand the tax savings, let's say we did not do that loan. Jerry just invested the money. It's in her name. She puts the $1 million to good work. She gets the 5%, that $5,000 of income she'll have to claim on her tax return from that non-registered investment. Because she's in a high tax bracket, she's going to have to pay a lot of tax. In Manitoba, the highest combined rate is 50.4%. That means $25,200 of tax. That's a steep tax bill she'll have to claim on that interest. Now, scenario number two here, instead of doing that, let's say Jerry lends Ted the money. Kevin, what does that look like?
That is a completely different scenario. So if we take that and use that as an example, well, all of a sudden, Jerry loans the money to Ted. He invests it. Now there's $50,000 of income on Ted's tax return. Now, since Ted only had $80,000 or $35,000 before, that now gives him $50,000. He also has to claim the income because of the 1% that he has to pay on the prescribed rate. That's another $10,000, but that's also a tax deduction. So it goes from $85,000 to $75,000. Since he is not the one that has to deal with that, he gets to claim it as a deduction. So his overall tax is going to be $12,491. Jerry, on the other hand, it is interest to them. It is income to them. So all of a sudden, you're going to find out that on that $10,000 at the highest tax bracket we had, the amount she's going to pay is $5,040. So overall, as we see, $17,331. The tax savings, $7,869. That's roughly a third of what it was without doing the prescribed loan at all.
Yeah. So instead of Jerry paying, 50% essentially on that 50 grand, it gets shifted to Ted. He ends up paying $12,491 on that 50 grand of interest or of gain on the portfolio. And then you factor in the fact that Jerry's going to have to pay some tax on the interest she claims from the loan. But still, the total there going from 25 grand to 17 grand. And that's every single year, right? And the money is still invested. That portfolio is still growing. and they're making that savings because they're paying that much less tax. So it is a key strategy. Again, we did the spousal loan version. You could be using corporations, trust, lots of different ways to look at that. A few keys here. One of them, and this is big, is the difference in the tax rates.
Yes.
Yeah,
that's a big one going forward. We got, what their tax rate is going to be a huge one. The higher off, the bigger the income that somebody has, of course, you're going to be paying at a higher tax rate. Whereas if you can lower that and split it between them, that's the main reason to do this, is that we want to get it into lower tax bracket. We want to bring things down so that you don't have to worry about that. And again, we've looked at this as more of a high level scenario. We've indicated things that it's strictly interest that we're looking at. And we're looking at round numbers to be able to deal with. It could involve a lot of this, but as you can see, the strategy gives you that sort of a tax advantage going forward on a long-term basis, as long as the loan's in place.
It does, absolutely does. And you can keep that loan in place for many years. Like we said, there's not a time limit, not a time frame that has to be attached to that. But if there isn't a big difference in the tax brackets, if the two spouses are closer together, well, there'll be less of an opportunity for the savings. And of course, whenever you're dealing with tax strategies, always talk to your tax specialist. Get your accountant on the line. Make sure it's going to be a fit for your situation. We talked high level of how the strategy could work. You want to make sure your tax specialist is on the same page before you implement something of this nature. And if you have other questions, Kevin, where should they go?
Everybody should go to Chat with Clinton and Kevin all the time to ask the questions that were needed. So if you can visit here, it can be questions on the prescribed rate loan. We can talk to it in a little more detail if you want, or any of the other topics that we've set out, or something financial that you may want to know. Please make sure to contact us. If not, get in touch with us at our website, and we can be able to help you with those sort of scenarios. Otherwise, that's sort of a quick overview, should I say, on how to save tax with a prescribed rate loan. I think that we've solved up pretty much the main questions for it. Clint, any final words?
I think we covered it all. So everyone take care, stay safe. We'll be back again soon with another video.